Dear students, today we can discuss about the remaining basic accounting concept. In the previous video we discussed about some of the accounting concepts. So remaining concept we can discuss. One is revenue recognition concept. Revenue, we know that one of the major revenue of every business is sales. So when sales realize at that time only we will consider it as the sale of the business. That means this concept states that the revenue for a business transaction should be considered when a legal right to receive it arises. That means the revenue will be recognized when sale has been made or services has been rendered, and not when money is received and not when the order is placed. Its meaning is, we know that whenever for a sale we are getting some order in advance, right? For our business we getting some order in advance. So receiving order in advance is not considered as sales. When real sales happening, at that time only we will consider it as our revenue. Sometimes sales will happen today, but we will receive the money on a future date. But which date sales happen, that date we will consider it as it's our revenue. Money may be receiving in a future date, but even though money receiving on a future date, which date is sales or revenue recognized, okay, that date we will consider it as revenue realized, or revenue we will consider it as sales, not on the date on which money receiving or order placed. That concept is known as revenue realization or revenue recognition concept. And another concept is matching concept. This concept states that expenses incurred in an accounting period should be matched with revenues during that period to ascertain the amount of profit or loss incurred during the period. That means when you calculating the profit or loss, we know profit means excess of revenue over expense, right? But when you take in that revenue and expense, the revenue and expense belongs to same accounting period. If you calculate the profit of this year, we should take the revenue of this year and expense of this year. You cannot take a expense of previous year and revenue of current year. Same way you cannot take a expense of this year and revenue of the next year. It should belongs to same accounting period. That concept is known as matching concept. The expense should match with the revenue belongs to same period to ascertain the profit or loss of a particular period of time. Next is full disclosure concept. Full disclosure means to reveal, right? So it is stated that all relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statement and their accompanying footnotes. So whenever we preparing financial statement, that is profit and loss account and balance sheet, we should disclose the complete information or full information. If any information means a relevant fact, the related facts or relevant facts, it's a completely and fully we have to disclose in the financial statement. If any information additional note is required downside the financial statement, we will write as a footnote. Okay, so this is known as full disclosure concept. So according to this concept, all relevant facts of an enterprise must be fully and completely disclosed in the financial statements. If they need any additional note related to that topic, downside of the financial statement we can show as a footnote. Okay. Now the next concept is consistency concept. Consistency concept means we studied one of the qualitative characteristics of accounting is comparability. Okay, if you follow the uniform method every year, then only we can comparison will be possible, right? So all accounting principles and methods should be applied in a similar way from one period to another, so that data reported in the financial statement can be comparable. So if this year we following one method, next year we following another method, when you presenting the financial statement, then comparison will be difficult. That is intra-firm comparison. If you want to compare the financial statement of another firm, then also the same, both the firms should follow same method of and same principles in the uniform way. Then only comparison will be possible. Then conservatism or prudence concept. Next concept. This concept states that business transactions should be recorded in such a manner that profit are not overstated. So we never overstate or exaggerate the profit in the financial statement. Okay. So when you recording all anticipated losses, whatever losses we are expecting this year, that all losses we have to record. But all unrealized gain, any unrealized profit is there, that we have to ignore. Okay, so all expected losses we have to record, but all unrealized profit or gain we should be ignored. Then only the profit are not overstated. Okay, so this conservatism or prudence concept state that the business transaction should be recorded in such a manner that profit are not overstated. All the anticipated, all expecting losses of current year we have to record, but all unrealized gains, unrealized profit we have to avoid. Okay. Then materiality concept. This concept refers to relative importance of an item or an event. That means an item should be regarded as a material if it is believed that its knowledge would influence the decision of user of financial statement. Means every items not having that much important. Some item may be importance to one organization, but the same item may be not much importance to another organization. If you say, suppose we know that pencil, paper, this all we are using in the business, we purchasing. But we are not recording it its own name. We are not writing it as a pencil. We are writing it as a stationery. But we are not considering it as an asset, right? So because these all are not that much important. So one important thing can be unimportant to another organization. If you consider another example, when you purchase a new machinery, it's a nature and it's a huge amount. This should be considered. This will be influencing the decision of the user. So some nature as well as some amount we are spending for a particular item is very relevant. So relevant item or important items we have to be recorded in such a manner which will affect the decision of the user. Some items like stationery items we are ignoring because that is not that much relevant. So material means relevant information we have to be recorded or considered as such a way because it influences the decision of the user. Then objectivity concept means this state that accounting transactions should be recorded in an objective manner. Objective manner means it is not based on the assumption of the accountant. So according to the accountant's wish, we cannot record the business transaction, but it should be according to the evidence. So every business transaction we have evidence or documents, some proof is there. Based on that proof only we have to record the transaction. It never be based on the related to the accountant. It is not according to the wish of the accountant. Okay, it should be based on the evidence available or the documents available. So we have to record the transactions in the books of accounts based on the evidence or documents or voucher, not on the based of the wish of an accountant. That concept is known as objectivity concept. Okay, so these all concept once again go through and study well. Okay, thank you so much.